All right, let's dive in. We're going deep on free cash flow
The
today.
free cash flow.
FCF.
Yeah.
You know, you gave me some really interesting stuff to read about this,
Mm-hmm.
and I'm excited to get into it with you.
Awesome. Looking forward to it.
So FCF, it's kind of like what a company has left over, right? Like after they pay all their bills and stuff.
Yep.
And
Like their financial wiggle room.
exactly. And the thing that really jumped out at me was that it's not just about how much FCF they have,
Right.
but like the trend over time, like if it's growing or shrinking.
Exactly. You got to look for those clues, not just like a snapshot in time.
Yeah. Speaking of clues, I saw this one article that called FCF the lifeblood of a company.
Hmm.
I thought that was a pretty powerful image. What makes that analogy work so well? Why is FCF that important for a business?
Well, think of it this way. A company with strong FCF, they've got options, They can reinvest that cash, develop new products, expand, gobble up competitors, or they can give it back to shareholders, dividends and buybacks and all that.
Right. So it's about having choices, being able to make moves.
Exactly. Whereas a company with weak FCF, they're kind of stuck. They might have to take on more debt or even sell off pieces of the business just to survive.
Yeah, that makes sense. And the material you sent me, it
Right.
really hammered home the importance of consistent FCF growth. It even mentioned 5 years as a kind of benchmark.
Right.
So why is that 5-year trend so crucial for investors? What's so special about that time frame?
It's like a stress test, It helps you see if a company's success is a fluke or if it's the real deal.
Right, like one good year could be luck, but 5 years in a row.
Exactly. That suggests they've got a solid business model, they're running things efficiently, and they can adapt to whatever the market throws at them. It's a sign of resilience and long-term potential.
And resilience is key, especially these days. Now, you mentioned operational efficiency. I saw a term pop up a lot in the material, CapEx, or capital expenditures.
Uh-huh.
Can you break that down for us? What is CapEx, and how does it fit into this whole FCF puzzle?
Sure. CapEx is basically the money a company spends on those big-ticket items they need to run the business.
Okay.
Think property, equipment, technology upgrades, that kind of stuff.
Gotcha.
It's like investing in the tools of the trade, right? Now, this stuff is essential, but it can also get pretty pricey.
Oh, yeah.
So a company that's good at managing its CapEx can keep those costs in check while still investing enough to stay competitive.
So it's a balancing act, like spending enough to grow, but not so much that it drains your FCF.
Exactly. Finding that sweet spot is key.
Okay, that makes sense. You know, all this talk about FCF is making me think about those times when I've looked at a company's cash flow statement and thought, wow, this looks amazing. But then I remember what I read in the material you sent.
Uh-huh.
FCF alone, it's not enough to make a decision, right? What else do we need to consider? What are we missing if we just focus on FCF?
You hit the nail on the head. FCF is a great place to start, but it's just one piece of a much bigger puzzle.
So what are some of those other pieces? What else should we be looking at?
Well, first off, you got to think about profitability. Are their margins strong? Are they getting better at converting revenue into actual profit?
Because a company could have great cash flow but still be losing money on every sale.
Exactly. That's
Yeah.
not a sustainable situation.
Not at all. What else?
Financial strength is key. How much debt are they carrying? A big debt load can really eat away at FCF over time, even if the business is otherwise doing well.
It's like having a leaky bucket, even if you're pouring in tons of water.
Perfect analogy. And then, of course, there's the human factor, management quality. Are these people competent? Do they have a track record of making smart decisions that benefit shareholders?
Yeah, that's always harder to measure, but so important.
Absolutely. And two more big ones. Valuation and industry. For valuation, we want to find those hidden gems companies that are generating strong FCF, but whose stock price hasn't caught up yet.
Undervalued.
Exactly. And then industry analysis is all about understanding the bigger picture. Is the company in a growing market? What's the competitive landscape like? Are there any disruptive trends on the horizon that could shake things up?
So it's about looking at the company from every angle, taking a holistic view.
Precisely. When you consider profitability, financial strength, management valuation, and the industry, you get a much clearer picture of a company's true potential.
Right. It's not just about the numbers, it's about understanding the whole story.
Exactly.
Well, I think we've covered a lot of ground today. It's been a fascinating deep dive into the world of free cash flow.
It's been a pleasure.
But before we go, I want to leave our listeners with something to think about. We've been talking about FCF in the context of publicly traded companies.
Mm-hmm.
But what about applying these concepts to your own personal finances?
Yeah. How could you use the idea of free cash flow to make smarter decisions with your own money? Something to ponder.
Absolutely. Food for thought as you continue your own deep dive.
Enjoy the journey.
Thanks for joining us, everyone. We'll see you next time on the Deep Dive.
See you then.